Hi, I'm Peter Rose, founder of Longwood Currency Trading. I wanted to talk a little bit more about the economics of Forex. I did a video not long ago. This is, by the way, this is 2023, mid-October, so maybe 4 videos back, on the only economics that you need to know in order to trade Forex. And that economics was a discussion of interest rate policy that each federal government of a country is responsible for managing. That's the dog in the whole thing. Everything else is kind of the tail. And I mentioned some things that if you ran into a period where the country's interest rate policy was not changing substantially from federal board meeting to federal board meeting. I mean, in the United States, again, we're 2023, since 2021 or something, we've had 14 changes in our interest rates, all going up to combat the inflation that we're having due to the pandemic and the printing of money to provide services and funding and all that other sort of stuff. So, I mean, it's all a gobbledygook of stuff, right? But when it all boils down to an understanding of how a country's economy is going to affect its currency price, the dog in that is the interest rates, and I talked about that in that last video. Now, I did mention that in a period when the interest rates were not changing radically, that didn't necessarily mean that the country's currency price wasn't going to be affected, because there are other things that are under consideration, and that's what I want to talk about today. What is it that affects the interest rate policy decisions that the federal government has? Well, it's the health of the economy. For example, they're going to need to raise interest rates if inflation is very high in the country. And so, though the indicator that we're going to be watching closely is interest rate policy, what causes the interest rates to be moved up or down? Well, we just said inflation. Well, what causes inflation? Well, that's a figure in the United States called consumer price index. So that's sort of the third leg of the table here. The other one is has to do with employment. I mean, if companies are hiring like crazy, they're paying more and more money to attract talent to come to them, and that's going to cause inflation as well. So the two primary legs that the interest rate policy stands on is the payrolls, which in the United States are non-farm payrolls, and consumer price index, CPI. Now, non-farm payrolls, we don't include the payrolls of farming into our calculations. We do, but this is NFP, non-farm payrolls. And why do we do that? Well, because the non-farm payrolls are, or the farming payrolls are a seasonal aspect of the United States, because they're not as active picking crops and all that sort of stuff as is the case everywhere. So you might want to look at your country's how they track payroll increases. In other words, the hiring process through whatever equivalent the NFP in the United States is to your particular country. If there's a lot of activity, a lot of hiring going on, that's going to affect federal policy, because at some point it's going to start to affect interest rates and inflation. And the other one is CPI, Consumer Price Index. If you're going out to dinner and it costs you $20 for an entree, and then all of a sudden costs you $22 an entree, that's a price increase for you. You go to, I'm looking at having the underneath of our cars oiled, because the salt they put down on the roads in the wintertime, you want to oil undercoating. 2 years ago, I was paying $180 a car to have that done, and the pricing today is pushing $300. That's a consumer price index. We went out to dinner the other night, and I think my entree was $28, and for the same thing about a year and a half ago, it was $23. It was a scallop dinner, so those prices are going crazy. I just bought scallops to fix for us for dinner the other night, and I was paying, let's see, it was $23 a pound, and it wasn't too long ago that was $20 a pound. That's consumer price index. Those consumer prices are rising. That's an inflationary force. And so the combination of non-farm payroll and consumer price index is a huge factor in the determination from a federal standpoint as to what the federal banking board or whatever is going to do to make sure that inflation doesn't continue by raising the interest rates or lowering them in the reverse of that. There's also a statistic that we follow, PPI, which is producer price index, how much more it costs the producer to produce their goods, which means they're going to charge the customer more for it. So the real key one is the consumer price index, and not so much the producer price index. The producer price index is kind of another tail that causes the consumer price index to increase. So you want to keep things simple. I mean, if you're interested in this stuff, you want to keep things simple. You don't want to be checking 19 different things, because all you're interested in is what is the probabilistic calculation that I can do among as few things as I can do to determine what the economic factors are that are going to deal with my country's currency price. Is it going to go up or is it going to go down based on the interest rate policy that is going to be implemented? It's not enough to know what simply what the interest rate decisions of the federal government are going to be, because those interest rate decisions are based on actually what's happening, which is reflected more in the non-farm payrolls and in the consumer price index, and subsequent to that, at a third tier down, would be the producer price index. Now, there's 42 other things that we can take into consideration when we're talking about interest rate policy and all that other stuff, but let's keep it simple and just have those two: non-farm payrolls and consumer price indexing. And I think if you casually just read the news about the two pair countries that you have, keep them in mind as to what their policies are, you're going to see generally that what's happening in one country is a little bit different than what's happening in the other country. Don't forget, if the interest rates are very low in a country, the economy is stable and everything is going along fine. So though not anybody's going to want to, not a whole lot of people are going to want to buy your debt in the United States, that would be T-bills. You look at the T-bill rates, a 30-year rate at 4.75 or something like that today, might be 3.0 in relationship to some other countries, 4.5. So you're going to go to that other country. You're not going to come to the United States if our T-bills aren't going to be paying you the interest. However, with a low currency value, a lot more people are going to be wanting to buy the products that we're producing. And so there's a balance between all that stuff that's going on, and you can get really, really, really lost in the deep woods if you start trying to track all this stuff instead of just trading, looking at the price that's out there on the computer screen in front of you and saying it's either going to go up or it's going to go down, and how long will it go up and how long will it go down, and what's the probabilistic projected momentum, or what some folks would call volatility. I don't like the term volatility because volatility tends to be sporadic, whereas momentum, as a definition in physics to define the two, becomes more consistent. And so I tend to look at momentum instead of volatility or velocity, even though velocity is a component of the calculation of momentum. Mass times velocity is momentum. So I'm wandering around here in the leaves. You can hear me clicking along here. Again, we're the early part of October. We're in fall now. Last time I was out here, we weren't crunching through leaves because there weren't a whole lot of leaves down. But as you can see, there are a whole lot of leaves down. I'm out here by the woodpile because before I started this video, I came out and took a look and started picking away at that corner of the wood. We've been having a fire. We had a fire going last night. It was 45 degrees when we got up this morning, so it was pretty chilly last night as we were sitting there watching a movie. We were watching one of the Equalizer films with Denzel Washington, finishing off our wine, and wondering. It was wondering. I have a position running, and that position right now is reacting because of the recent announcements of the inflationary pressures manifest in non-farm payrolls and in consumer price index. Not so much the interest rate policy, because they're not meeting to change that. It's only speculating, oh gee, we just got these non-farm payrolls, we just got these consumer price index numbers, and what's the Fed going to do when they meet, whenever they're going to meet? And so the market, you can't take a piece of news like that and go in and trade the market. You have to look at if you're going to trade fundamentally, particularly in the currency markets, because of their huge size, you can't look at them like a motorboat that you just spin the wheel and the thing goes off in another direction. You have to be more patient, because it's like an ocean liner that moves around. The economy moves along slowly, and the orders that manufacturers and producers are putting in, that was stuff that was done maybe 6 months ago based on what they thought interest rates are going to be in the forward. That's why you look at the futures market. You look at the forward futures pricing of corn and wheat and aluminum and all the other stuff that goes with it, and you make projections out. You buy your futures contracts to protect yourself from price increases and whatever. So that stuff is all in place right now. So the fact that non-farm payrolls went up 370,000 and they were only expecting 170,000, yeah, boom, that's a big thing. And the non-farm payroll day, when that was released at 8:30, price of the currency pair that I trade went, and then like that. You probably didn't see that off screen, but it was a lot. It's a lot of movement, but it's back to where it was, because that was just the immediate reaction for people that had made bets on either side. And since 50% of the traders are going to be wrong, after price goes up past their pain point, they're all going to reverse their position, right, and get out. And so that's why you have these 50% retracement things that had nothing to do with Fibonacci. Damn. Okay, I'm not going to go into that. I'm not going to go into that today. Just be aware of the fact that though I did say 4 videos ago that the interest rate was the dog in the whole thing, it is, but what causes the dog to bark? It's something else that's going on, and the key component to that, and I don't think there's one that's can be added in there at an equal level to whatever your non-farm payrolls are and whatever your consumer price indexing is. Again, you could add in producer price index, but why complicate things? Because producer price interest rate or producer price rates are so correlated with the consumer price index that you're really looking at the same thing. It's like looking at a 5-second chart and then going up to the 5-minute. You're looking at the same. You're looking at the same thing. It's just the 5 minutes kind of or the 5-second is kind of a precursor to what may happen on the 5-minute, but it flatters around so much that it's not as stable. The producer price index is not going to be quite as a good of an indicator for you as the actual consumer price index, because things don't start to affect the indexing of the interest rate policy until the consumers start screaming. Okay? A little economics from the top of the mountain in New Hampshire. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.